That single sentence should stop you cold, because what's fueling this foreclosure surge has almost nothing to do with what lenders and headlines keep pointing at. It's not your interest rate, it's not unemployment, it's the pile of costs stacked on top of your mortgage, it's insurance, property taxes, HOA dues, utilities, quietly compounding every month until the math simply doesn't work anymore. Here's where things actually stand. Adam's full year 2025 report shows total foreclosure filings covering default notices, scheduled auctions, and completed bank repossessions reached 367,460 properties nationally. That's a 14% climb from 2024 and 3% above 2023 levels. Of that total, 289,441 were fresh foreclosure starts, meaning the legal process officially began on those homes. These aren't old cases working through the pipeline, and these are families who received notices this past year, families currently navigating lender calls and figuring out what comes next. That works out to roughly 1,000 households a day, and December made things significantly worse. Foreclosure starts surged 46% compared to December of the prior year. Completed repossessions, homes the bank physically took back, more than doubled year over year. Lenders repossessed 46,439 homes across 2025, a 27% increase. That's not paperwork in a drawer. Those are families who already lost. To understand how quickly this can happen, consider a situation that made national news last year. A 57-year-old woman on disability had been managing her expenses because a family member was contributing $600 a month toward the household. When that person moved out, her financial cushion disappeared, and within months, she was in foreclosure proceedings. That's how narrow the margin is for millions of homeowners. One change in circumstances, one added expense, and a household that was managing just fine collapses. Interest rates get blamed constantly, and they're a factor, but they're not the engine driving this. For anyone who locked in a fixed rate mortgage, that payment hasn't budged. The principal and interest are exactly what they were on closing day. What has moved aggressively is everything surrounding that payment. The average homeowner carrying a mortgage is now paying close to $2,370 annually for property insurance alone. 5 years ago, that number was roughly $1,400. That's a 70% increase on a cost that most people treated as a fixed background expense. In states like Florida and California, it's far worse, and the rate increases aren't even the full story. Major carriers, State Farm, Allstate, AAA have pulled out of high-risk markets entirely. When private insurers exit, homeowners get pushed onto state-run last resort plans. Those plans typically cost twice as much and offer weaker coverage. The cycle that follows looks like this. Insurance costs spike, total monthly housing expenses become unmanageable, the homeowner tries to sell, but the buyer they're hoping for faces the exact same insurance reality. So the home sits. Time runs out. A payment is missed. Then another. Then the lender starts the clock. That's the mechanism behind a large share of those 289,000 starts. These weren't people who overextended at purchase. The purchase was manageable. The ongoing cost of ownership is what moved out from under them. Now, here's a piece of data that doesn't get nearly enough attention. Climate risk research firm First Street found that for every 1% increase in insurance premiums, the national foreclosure rate rises by approximately 1%, 1-to-1. Apply that ratio to a 70% premium increase over 5 years, and you start to see the structural problem taking shape. First Street goes further, projecting that climate-driven foreclosures from flooding, wildfires, and wind events could surge 380% over the next decade. Their estimate is that by 2035, roughly 30% of all U.S. foreclosures will be tied to climate-related events. Today, that figure sits around 7%. A fourfold increase in 10 years, and here's the specific vulnerability almost nobody is checking. Flood insurance is only required by mortgage lenders when a home sits inside a FEMA designated special flood hazard area. The problem is that FEMA's flood maps are badly outdated. Millions of homes carrying real flood exposure are technically outside those zones, which means no flood insurance requirement and often no flood insurance at all. First Street analyzed 29 major flood events between 2002 and 2019 and found that homes outside FEMA flood zones experienced foreclosure rates 52% higher than homes inside those zones. The reason is straightforward. Homes inside the zones had required insurance. Homes outside had none. So when floodwater came, the families who assumed they were safe had no financial backstop. That's not a future risk. It's a pattern that's already established. The geographic concentration of this crisis is worth understanding. The 3 states with the highest foreclosure filing volume in 2025 were Texas at 37,215, Florida at 34,336, and California at the 29,770. At the metro level, New York led with 14,189 foreclosure starts, followed by Chicago at 13,312 and Houston at 13,090. Florida had the highest statewide rate. 1 in every 230 housing units received a filing. On a typical residential street in that state, there's a statistically meaningful chance a neighbor is currently in the process. But it would be a mistake to treat this as a coastal problem only. First Street's projections show that extreme rainfall and river flooding will push foreclosure risk higher in inland states as well. The Mountain West, the Great Lakes region, areas that most people would never associate with climate-related housing risk. If your basement fills with 4 feet of water and you have no flood coverage, it doesn't matter whether you're in Miami or Missouri. Here's what the stress scenario looks like in practice. A buyer in Houston closed in 2021 with an FHA loan, 3.5% down. The mortgage payment locked in at $1,800 a month. Since then, insurance climbed from $1,400 to $2,600 a year. Property taxes crept upward. Total monthly housing costs quietly shifted from 32% of gross income to 41%. No payments have been missed yet, but savings are gone. 1 car repair, 1 medical event, 1 job disruption, and this household enters the pipeline. That scenario is not hypothetical. It's the financial profile of a large portion of the borrowers behind those 289,000 filings. The highest risk borrower category right now is FHA. Here's why the numbers are alarming. There's a tool called a partial claim, a mechanism that allows a loan servicer to bring a delinquent borrower current by deferring missed payments to the back end of the loan. In 2020, about 5% of FHA borrowers had used one. By 2025, that number reached 50%. Half of all FHA borrowers have already drawn on this option. Under current FHA loss mitigation guidelines, borrowers who've already used their partial claim may not have access to it again. That safety net for many of them is gone. Layer in minimal down payments. Purchases at 2021 or 2022 peak prices with little appreciation since, and state down payment assistance that left equity thinner still. And you have a borrower profile with almost no cushion remaining. It's also worth noting that roughly 94% of mortgage defaults follow an income disruption, a job loss, a health crisis, a divorce. It's rarely costs alone that trigger a default. The costs build the pressure. A life event provides the trigger. For FHA, borrowers already at 35 to 40% housing cost to income ratios, that trigger doesn't need to be dramatic. There are 3 specific steps worth taking this week before anything goes wrong. Step 1, go to firststreet.org, enter your address, and run the free risk assessment. It covers flood, fire, wind, and heat exposure. And it pulls from far more current data than FEMA's maps. If your home shows elevated flood risk and you're not carrying separate flood insurance, that's the gap that has turned weather events into foreclosure proceedings for thousands of homeowners who thought they were covered. Step 2, Do the full housing cost calculation, not just the mortgage. Add insurance, property taxes, HOA, utilities, and a reasonable monthly maintenance figure. If that total has crossed 35 to 40% of your gross monthly income, you're inside what lenders call the stress zone. One unexpected expense can set off a chain reaction. Most homeowners know their mortgage payment precisely. Very few have actually done this math. Step 3, know your equity position and understand your options now, not after you've missed payments. This is where most people make the critical mistake. They assume they'll catch up next month. They avoid calling their servicer out of embarrassment or pessimism, but at 90 days delinquent, options shrink dramatically. If you're an FHA borrower, find out now whether you've used your partial claim. If you have, you need to build a different plan before a disruption arrives. Calling your servicer before you're in default is not a sign of failure. It's the move that keeps more options open. The homeowners who lose their properties are rarely the ones who couldn't have been helped. They're the ones who waited. If you want to stay ahead of data like this, US Realty Pulse covers new housing market developments every week. Hit the notification bell so you're seeing it when it matters, not days after the window has already moved. The bottom line here is this: the foreclosure wave building across the country isn't fundamentally an interest rate story. It's an insurance story, a climate risk story, and a rising cost story. And it's accelerating. If what you heard today changes how you're thinking about your own position or someone else's, pass it along. The next one is already in the works.